Hi, I'm Matt Rosenberg with RoseCap Investment Advisors. This video is to give you a quick update on some of our portfolio management strategies and on how the market conditions over the past few years may require some adjustments to your portfolio going forward. As you hopefully know, our goal in managing portfolios is always to maximize your returns. However, we have to do that while making sure we're not exceeding an appropriate amount of risk in your portfolio. The appropriate amount of risk for you has to do with your financial goals. In short, risk is something we look at very closely. And over the last few years, the risk in markets has declined quite a bit. Let me show you what I'm talking about. Here's a graph that shows the standard deviation of price returns going from today back to 2008. Standard deviation is a measure of dispersion or volatility, and it's used in finance to measure the risk of investment returns. The blue line is the S&P 500, which most of you are probably familiar with, but if not, it's referring to the risk involved with investing in an index comprised of the 500 largest U.S. stocks. The yellow line, the MSCI EAFE index. EAFE, just so you know, stands for Europe, Australasia, and Far East. So this refers to the risk involved with investing in international developed market stocks. The trend in this graph is pretty clear. Since risk spiked in the financial crisis, the risk in equity markets has declined pretty significantly. In fact, 2017 is almost record-setting for the low level of risks shown in stock markets. The long-term average for the U.S. stock market is about 15.3% for standard deviation, and in 2017 year-to-date, the risk of the stock market is only 6.7%, or less than half the long-term average. So what does this mean for your portfolio? Well, here's a graph that shows a concept called the efficient frontier. Each of these 5 dots represents a target risk level for a portfolio. The yellow dot in the middle is our moderate risk target portfolio, and I'm going to use that for an example, even though the same concept really applies to all risk levels. You can see that it's designed to have 6% risk, as shown by the standard deviation here on the x-axis. The way we target this amount of risk is through asset allocation, or setting the amount of stock versus bond versus other asset classes that are held in your portfolio. Because the level of risk in the stock market's been so low, we've been able to achieve 6% risk in this moderate target by including more stocks in the portfolio than we would historically have been able to include. This has been great because more stocks should be higher returns over the long run. However, if the stock market were to return to its historical levels, your portfolio would have too much risk. Here's what that would look like. So the yellow dot would actually move out to the right and up some. Again, this could have higher returns, although it might be too much risk for your portfolio and achieving your financial goals. So what we have to do is adjust your asset allocation just slightly to reduce the amount of stock and increase the amount of bond held in your portfolio. I want to emphasize that we're not trying to sell out of the market right now, or we're not trying to time a market downturn. I know there's been a lot of talk of that with stocks at pretty much all-time highs, but that's not what we're trying to do. Staying invested is an important part of our investment philosophy, but we do have to make sure that you have the appropriate amount of risk in your portfolio relative to your financial goals. So here's what the change will look like in your portfolios. Using the moderate target allocation as an example again, the graph on the left is showing the current allocation for moderate. The red is U.S. stocks and orange is international stocks. Blue and purple are U.S. and international bonds respectively. So you can see this current allocation we're in has a risk level of 7.3% if the risk of stocks were at its historical norm. The new allocation pulls back a little bit on the level of orange and red, or international and U.S. stocks, and would put us at a 6% target risk level based on historical risk in stocks again. And that's where we want to be for the moderate to be consistent with your financial goals. So we did this analysis across all our targets, whether you're in the very conservative or a very aggressive portfolio, and I'll post these slides and make them available to you in this email as a PDF file. I just want to emphasize one more time that we're not trying to time the markets, and we're definitely not going to sell out of the markets. We're just really trying to control the risk in your portfolio to make sure it's consistent with your financial goals. I'll put some more detail of this in this attachment or PDF file in the email I sent, so you can view those slides at your own leisure. But if you're still not sure what we're talking about, just know these few simple things. First, nothing's required on your end. Most accounts shouldn't have any trading costs associated with these moves, and if there are, they should be very nominal. We believe the benefits of those would offset the costs. And then last is RoseCap. We don't receive any extra compensation or fees for doing this. It's really only because we believe it's in your best interest. So if you have questions or would like to discuss this anymore, please don't hesitate to give me a call. I'm always happy to hear from you.